A to Z of stock market. A for Apple. If you actually make a bite out of it, it will look like the company Apple. I mean, sort of. B for bull market or bear market. C for crypto. D for debt to equity ratio. E for ETFs. F for fractional shares. G for genius. Parle G. I'm just kidding. In this video, I am going to literally pick each letter from English alphabets from A to Z and will explain the terms related to the stock market. I will be adding the timestamps of each letter. So wherever you want to start this video from, if you think you want to start this video from the first letter of your name, skip the video directly to that letter. And also the idea was to have one letter, one terminology, the basics of what it means with examples. But while recording some of them, I've explained more than one terminology. So hope you will like this video. Let's get deep. It's actually not a deep analysis, but for the usual style purpose, let's get deep into the A to Z of stock market in this video. A for assets. What do you mean by assets? There are three things under this: assets, asset classes, and asset allocation. Asset means a company owns valuable things that can be converted into revenue or cash. In simple words, for example, my line of business is video production. These lights, camera equipment, recording, computers, etc. are all assets. Some companies own buildings and lease them for office rentals. Machinery, for example, are directly used to produce goods and services, right? There is direct benefit. These are physical, like machinery in the manufacturing companies. Assets can also be intangible, like intellectual property or a share or stock of the company, which is literally not physical. Asset classes are nothing but of different types of assets, like cash is an asset, equity like stocks in stock market, or percentage of ownership in a startup like real estate, fixed returns like bonds, physical equipment, intellectual property like patent or any other securities. Now, where can you find the assets of the company? If you want to figure out how much assets the company owns, you can check their consolidated balance sheet. It will clearly state assets versus liabilities. Now, asset allocation means how you are dividing these assets in your investments. How much cash do you have? How much in stocks, bonds, real estate, etc. Allocation is basically portfolio of percentage share of each. B for bull market or bear market. Bull market is when the trend in the stock market starts going upwards. Stock market runs based on market sentiments. It means speculation that prices might go up so that retail investors start buying the stock. When more and more people start buying the stock with a speculation that market might go up, right? This is where the rising trend happens. This rising trend is called bull market. The bear market is the opposite, where the speculation of prices might go down, people will start selling the stock. How did they name bull and bear? Why not other animals? There are so many other wild animals, right? There are actually different stories around this, but what comes to the closest to reality or closest to believing is the way these two animals fight. When the bull fights, it attacks from the horn, pulling from down, using all the strength and going upwards. It leaves an upward rising mark. So they used this symbol for bull market. Whereas the bear scratches with strong paws, scratches from top and brings the opponent down. This symbolizes the market going down, the trend that pulls the market downwards. C for cryptocurrency. Cryptocurrency is not a real currency. It is virtual and completely digital and is stored in network databases. Purchases or transactions happen only through digital. How is it different from the current money currency that we are using? Even though there is digital currency in our system, the current financial world is completely controlled by the central banking system. For example, in India, RBI is the governing body, which distributes to the banks. Then it comes to the end users. You have your bank accounts. From there, you do all your transactions. Crypto has no governing authority or bodies or banking system. This is stored completely in a digital wallet. Those who hold the currency will store the ownership data backed by blockchain technology. A lot of platforms in India offer Bitcoin crypto investment in multiple ways, like Bitcoin trusts, Bitcoin mutual funds, ETFs, etc. C is also for capital gains. Capital gains means any profit you earn from the stock. Let's say you buy a stock for 100 rupees and when you sell the stock, the prices go up to 150. Then this 50 rupees is the capital gain, which is a taxable amount. If you sell it within 1 year, it is considered as short-term capital gains. 20% tax on this profit. Long term, which is anything more than a year, if you sell it after 1 year, you need to pay 12.5% as profit tax, which is long-term capital gains tax. C is also for candlestick. I had made a viral reel about this topic with actual candles. So that's why I didn't explain this topic here. So you can watch the reel and after that you come back to the topic. These are candles. And these are sticks. If you stick them together, they will become candlesticks. You would have seen them in the stock market graph. What do they even mean? There are two colors in candlesticks. Green color, prices going upwards, and red color, prices going downwards. The lower body is open price of the stock. The upper body is closing price. In the red candles, it is the opposite. If the body is bigger, that means more momentum in selling or buying. If it is smaller, then lesser movement. Upper stick is the highest price of the time period. The bottom stick is the lowest price. If the upper stick is longer, that means prices went high and fell back to lower price. If the lower stick is longer, it means prices went falling down, but buyers hammered it back buying more stocks, which leads to higher stock prices. If you like candles. D for day trading. The name itself says day trading, basically buying or selling stocks during the day. These are professional traders who bet on the timings of the day. In India, the stock market opens at 9:15 a.m. in the morning and closes at 3:30 p.m. in the evening. It actually opens at 9 a.m., but they use this first 15 minutes for initiating the stock market transactions. We call it pre-market trading time. You can order in this period. The actual transactions won't happen before 9:15, which is the market opening time. But you can place the orders and these orders will be prioritized when the stock market opens. From 9 a.m. to 9:08 a.m., this 8 minutes is called the pre-opening period for the investors. You can place orders, modify or cancel the orders in this time. All those things can be done and you get 8 minutes for this. The next 4 minutes from 9:08 to 9:12 is for verification of the orders. They do price matching of the orders that were placed, exact transactions that have happened in this period. You cannot do any modifications after 9:08. By mistake, you placed an order at 9:01 a.m. and wanted to cancel at 9:10, you cannot do it. This is called pre-market trading hours. From 9:12 to 9:15, in these 4 minutes, the opening price of the stock will be set. How do they do it? By checking the demand and supply of the stock, by cross-checking the number of orders in the pre-market session. 9:15 a.m. the stock market opens and a massive number of traders keep participating in selling or buying the stocks. E for ETFs. What are ETFs and how do they work? In stock market, what happens is you buy or sell a particular company or a particular stock. In an ETF, you can buy portions of many stocks or securities at once. Think of it like a basket of different securities where you can buy or sell a portion of them. For example, some ETFs track only the bonds, usually give fixed returns because bonds are from the government. If you go to a restaurant, you will see in the menu, chapati, puri, anna sambar, kesari bath, etc. are separately, right? These are all separate dishes. Think of all of them in small portions on one plate. It actually becomes South Indian meals. Apply the same logic to bonds, stocks, commodities, etc. The main logic of ETFs is diversification, so that you don't have all the money allocated in one asset class and burning the money. All the ETFs have their own ticker that tracks only these listed under the ETF. ETFs are basically designed to avoid risks. F for fundamental analysis. Fundamental analysis is nothing but of analyzing the fundamentals of the company. In the stock market, it is the company listed in the public markets. By judging the company, how the financial health is, how the performance is, how the management is, how are the market conditions of that particular sector, if the stock is overvalued or undervalued, etc. One of the main things is analyzing the balance sheet. I've already made a basic explainer video on how to analyze balance sheet. You can watch the video in this channel later. Coming to another F is for fractional shares. Now, what are fractional shares? A fractional share is nothing but owning a fraction of the share. Instead of buying the entire share, for example, US stocks, they're very expensive. Some stocks are more than 10,000 rupees if you convert into INR. They're all in dollars. Now, you don't have that much money to invest. So what you do is you invest a small portion of that stock, as little as $1. Let's say the stock price is $100. You can buy $10 of that stock instead of buying an entire stock worth $100. Tomorrow you want to buy $10 more, right? Then your portion becomes $20 out of $100. Basically, that's what fractional share means. You buy a fraction of the share. G for government securities. These are securities issued in the stock market by the government. Why does the government issue these? To raise funds from the public. If you want to borrow money, let's say a term loan, you keep some securities in the bank to get a loan. If you have a regular good salary, then that salary can be used to borrow loans. Otherwise, when the amount is big, you need to keep some papers like house paper or property paper. The same way, to raise money, the government issues bonds in order to get money from the public. The purpose of raising these funds is for public infrastructure. The government of India has issued many types of bonds like fixed rate bonds, which gives 7% rate of interest returns. Sovereign gold bonds, where you cannot actually buy the real gold, but this acts like real gold investments. Then there is Government of India savings bonds, 7.75% interest rate returns. H for hedge funds. What are hedge funds? What do they do? Hedge funds are not for beginning retail investors. My audience are not professional investors with very high knowledge. That's why I'm making this video of introduction. Now, hedge means what? Hedge is nothing but a fencing or protection. Protection from the losses. Think of it like insurance, shielding yourself from risky situations. You keep paying the insurance amount. In the hedge fund process, there are three stakeholders. Retail investor, that is you, hedge fund manager who borrows the money from you, and then the stock market. These hedge fund managers will take massive risks from all the hedge money that are collected from people, right? If the market goes upwards, they will earn massive profits. If the market goes downwards, there will be a hit, but retail investors will not have a bigger impact through the losses. That is why hedging comes with premium features and premium cost. Hedge funds are not allowed for small investors. These are experienced, credited, and certified investors who are involved in the hedge fund business. The fundamental purpose of hedging, in my understanding, is reducing the risk of the losses that happen from the major market fluctuations. I for IPO, initial public offering. IPO is when a company offers shares to the public for the first time. When a company is registered as private limited company, shares are allotted to the directors or to external investors who have put money into the company. This is called equity in the company. For example, imagine you are starting a company with 3 directors. You register the company as ABC Private Limited with 3 directors. You are the CEO and other 2 are directors who are part of the management team. Let's say the 3 of you don't have enough money to run the startup. So you bring in an external investor. The external investor will not give money without something in return. So they will take percentage of equity from your company. This means they own some shares of your startup. If the startup makes good profit, a share of that profit also goes to the investor. If the startup grows even bigger, you might think of scaling up. You could go public and list on the stock market. Now, instead of a few investors, now you will have many more called retail investors. You can decide what portion of your company will be owned by the stock investors. Earlier, the investors were private equity owners. Now, a portion of the company is owned by the public, many investors, right? When you list on the stock market for the first time, it is called the initial public offering. J for joint venture. A joint venture or JVC is when 2 or more companies form a contract to start a new business entity. The companies involved can keep their own brands, but together they launch a new entity. This typically occurs when a foreign company wants to establish a business in India, or Indian company wants to establish business in the foreign land, and they partner with a local company. For example, Starbucks, a global brand, partnered with Tata Consumer Products to launch Starbucks in India, resulting in 50-50 ownership joint venture. This is called joint venture. K for Kite. Kite is a trading app by Zerodha, which provides detailed charts and company information to help users understand company portfolios. Zerodha also offers free detailed video series, and their varsity videos are available online for free of cost. I picked Kite because I did not find anything related to K in the stock market. There is actually knock-in and knockout in the options. It's a bit of complicated topic, and that's why I did not want to bring in those topics here. There is knowledge economy, which starts with K, but knowledge economy is more of industry or a sector rather than stock market jargon. That's why I thought Kite is a very familiar term, so you will understand easily. So I used Kite. Let's go for L. L for liquidity. What do you mean by liquidity? Liquidity refers to the movement of an asset or security, specifically how quickly it can be converted into cash. Cash is the fastest moving security, and other assets are compared to cash. For example, stocks are considered liquid assets if they can be quickly converted into cash. In contrast, an asset like a car, for example, is not very liquid because it takes time to convert a car into cash. Companies often keep their assets in a bank. Borrowing loan is also considered a form of liquidity. In the stock market, liquidity refers to how quickly assets can be bought or sold without affecting the stock price. Another L is for LRS. LRS is very important if you are investing in the foreign markets like US stock market. LRS means Liberalized Remittance Scheme. The LRS scheme allows people to send money from India to other countries like the US, for example. There are specific rules for sending money abroad. The limit is $250,000 per year. This limit applies to various purposes such as investing in the US stock market, higher studies, travel, and medical treatments. The process involves converting INR, which is Indian rupee, into US dollars, USD, and then sending the money from Indian bank to US bank, where it can be used to purchase stocks. If you need to send more money than the limit, you need to get permission from the Reserve Bank of India. M for mutual funds. So I think you would have heard a lot about mutual funds. Let's do a different M. Let's do market capitalization. It's also called market cap. All the companies have outstanding shares. The total value of these shares in the market called market capitalization. How do you even get this number? Multiply the stock price by the number of outstanding shares. You will get market capitalization. If the stock price is 100 rupees and there are 1000 outstanding shares, then 1 lakh will be the market cap of the company. But you don't have to worry about these numbers because everything is automatically updated every single day in the stock market. N for Nifty 50. Nifty 50 is an index of top 50 companies listed on National Stock Exchange based on their market capitalization. These are also known as the large cap or blue chip stocks. If you see the performance of this index, you will know how well the stock market is performing. Reliance, Tata, HDFC, Airtel, Infosys, Shell, ITC, all these top companies come under Nifty 50. One more N is for National Stock Exchange of India. The short name is NSE, which is in Mumbai. When it comes to number of contracts traded, NSE is the world's largest stock exchange. NSE is a private company, but the stock market is regulated by SEBI, which is a government entity. Next N is for NFT. A non-fungible token or NFT is something that gained popularity a couple of years ago with people online going crazy about them. There were reports of people making millions with NFTs, which created hype online. An NFT is a blockchain-based financial asset, or in stock market terms, a financial security. And it represents the ownership of a unique piece of work or memory. To give you a difference, or for example, a 500 rupee note with Gandhi's face can be broken into smaller portions, such as 50 rupee note or 100 rupee notes, but it is not unique. However, a painting is unique and cannot be broken into pieces or replicated. If an artist creates NFT of that painting, it acts as a digital certificate of authenticity for that digital storage, like cryptocurrency. The artist gets unique ID, and this is where NFT plays a role in the trade transactions. Cryptocurrency, such as Bitcoin, uses blockchain technology, which is similar. But what happens in cryptocurrency is there is a set of price. For example, 1 Bitcoin equals to 1 Bitcoin in the value. 2 Bitcoins equal to 2 Bitcoins in the value. Whereas the NFT can be traded at different values, like bargain in the market, right? And the value of one NFT can increase depending on the demand. And this technology helps people to store and secure the ownership of unique assets, which is NFT. O for options contract. You would have heard futures and options. Before getting to know these, I will give you some shocking news. More than 90% of individual traders suffered losses because of futures and options. The average loss per trader amounting to 1.2 lakh rupees. Little more statistics on these. Past 2 years, from 2022 to 2024, 11.3 million traders worth of 1.81 trillion money lost as per SEBI. Hope you get the failure rate on futures and options. Anyway, options need a separate long video to explain in detail. But in this video, I will give you a gist of what options contract is. Real estate will be very easy for you to get it. Let's say you want to buy land near Bangalore. Near the city is very expensive, so you go towards the rural side. I will give you an example of Kunigal, which is in rural area. Now you meet the seller in Kunigal. You like the land, both the seller and you are confirmed of purchasing the land. The land value is 10 lakh. Now you will get the news, right? The Karnataka government is planning to build an airport near Kunigal area. What do you think will become the value of the land? It will be very high, right? Let's say upwards of 50 lakh. If the airport comes, then you are on the profit side. You can make bigger amount, right? If airport doesn't come, then you will be on the losing side. That's why you need to come up with an options contract. The option is you will pay an upfront non-refundable fee. Whether the airport comes or not, this upfront fee, let's say you will pay 2.5 lakhs, you're going to pay to the seller. You will not get this money back. It just goes to the seller, whether you buy the land or not. The seller will have this money. If the airport comes, you will buy at agreed price plus this non-refundable cost. Even if other people are buying for higher price in the same area, you will not pay high. You will pay for the agreed amount. If the airport doesn't come, you will lose the upfront money, which is 2.5 lakh. But you will have the option to call off this whole agreement. This contract is what we call options contract. P for PE ratio. I had made a short video on this topic. I'll just play that reel here. Quickly watch this reel and come back for the next letter, which is Q. Q for quick ratio. How to analyze a company, part 2. Price to earning ratio, PE ratio, which is one of the important metrics because it shows if the company is overvalued or undervalued. To get PE ratio, we need to divide the share price by EPS, which is earnings per share. For example, if the company share price is 280 rupees and the EPS is 2.5, we will get 112 PE ratio. What does it even mean? It means for every rupee this company earns, the market is willing to pay 112 rupees. Now, how do you know if this is overvalued or undervalued? For this, we need to compare with competitors from the same industry. Let's say the competitors are averaging between 50 and 70. Then 112 is a bit high on the valuation, unless it is a new company which has very high potential for growth. PE ratio is a crucial metric to analyze a company, but it is not just enough. Q for quick ratio. Quick ratio is nothing but the current ongoing cash of the company. To get this, first we need to collect the total of all cash of the company, all accounts receivable and all short-term investment. Short-term investment means less than a year. Now you get the total of all this. Divide this total by current liabilities, which is nothing but of the debt the company has to pay within 1 year. You will get a ratio. In the finance world, where they use a term called acid test. If the ratio is 1 or higher, that means you have more cash and you pass the acid test. R for risk tolerance. Stock market is all about risk taking and betting on the market sentiments. Now, what is the risk tolerance? How much or what level are you willing to accept the risk on your investments? Some people take high risk and bet on the stocks, right? And they already are aware of the risks and they're okay to invest because they keep seeing what is the upside of that risk. Sometimes it pays off and sometimes it doesn't, right? I have seen people betting on some companies right before BJP government won the elections. But after the elections, a lot of things changed and many stocks didn't do well. Those who had higher tolerance already prepared for consequences like this. So they had higher risk tolerance. Usually people in jobs who are new to the stock market will not have higher risk tolerance. That's why a lot of people just go for some mutual funds. S for stock split. A stock split occurs when a company divides its existing shares into a larger number of new shares. For example, if the company with 100 shares executes a 2-for-1 stock split, it will have 200 shares. If you already owned 10 shares before the split, Now you will own 20 shares after the split. The total value of these shares will remain same. The price per share is reduced, but the total value of your holding stays the same, whether you have 10 shares or 20 shares, because you just have more number of shares. The main reason a company does stock split is to reduce the price of the stock so that more number of people can afford the stock. A stock split does not change the company's market cap or value. A stock split might increase demand for the stock, although there is no guarantee that the demand will go up after the stock split. For smaller companies, the problem is the cost of splitting includes legal fees, paperwork, and other charges will go high. So it is just a burden for smaller companies. It makes sense for the bigger companies. T for ticker symbol. Ticker symbol is a unique combination of letters and sometimes numbers that represents the company's stock listed in the stock market. For example, Apple's ticker symbol is AAPL, Tesla's is TSLA, and Microsoft's is MSFT. These are mainly used as shorter names. Companies can also use their full names directly. For example, Reliance uses directly Reliance and HDFC Bank uses their full name. However, company like Ford uses the letter F. That is, their F stands for Ford. When the company goes public, which is an IPO, right? Initial public offering, companies can suggest a shorter name to be listed in the stock market. If the name is already taken, they can come up with a different name or different alternative. For example, Google has two types of tickers. One is GOOGL, which is Class A main shares. Then they came up with another one, which is GOOG, which is Class C shares. The founders did this because they didn't want to give away the voting rights, so that they created the C class shares and made a separate split. With Class C shares, you cannot have voting rights. U for unlisted shares. Unlisted shares in simple terms are not listed in the stock market and directly traded in public stock exchange. Shares can still be traded, they can still be purchased, but they're not listed in the public stock exchange. I'll give you an example. On YouTube, for example, this video is public, right? You can go to my channel and you can see this video and then click and then watch the video, right? Because it appears in the video tab. I also have some other videos in my channel which are unlisted. You cannot watch it going to the channel, but these videos are there in my channel. If I give you the links of those videos, then you can watch the videos, but it is not appearing for the public because I've unlisted them. The same logic goes to unlisted shares as well. Unlisted shares are usually considered risky investment because valuation of these companies becomes very difficult to access. There won't be much of transparency. If it is a listed company, everyone will know about it, right? All the details will be public, and also it is mandatory for the companies to make it public. Unlisted, how will you know about the companies, right? Buying and selling also becomes very difficult. This means if you have some unlisted shares and want to suddenly sell and convert into cash, this becomes a difficult job. V for vested. Vested Finance is an Indian stock market startup where they exclusively focus on investing in the US stock market from India. The way US investing works is you have an Indian account, right? That is in rupee. Then there will be US bank, which is in dollars. You have to create a brokerage account in the US market. You need to transfer the Indian rupee to dollars from India to the US. From there, you need to buy the stocks from the brokerage account, which is from the US dollar currency. Vested Finance makes this entire process easy. So after Vested, many other stock market companies also started offering similar services because a couple of years ago, there was a craze for US investing. You would have noticed that like a lot of creators made videos about US investing, how to invest in US stocks, how to buy tech stocks, etc. Right? Now investing in the US stock market is not that difficult compared to 10 years ago. Another meaning of vested is vesting. Vesting means ownership, usually addressed in retirement of jobs. I will give you an example of ESOPs. Each employee will vest a certain percentage of their account or ESOPs for some years, and they will gain benefits from the ESOPs, which is basically money, right? In simpler words, if your company gives you ESOPs, you cannot suddenly take them and convert into cash. They will stay in the company funds for some period, whatever period the company has set. This is called the vesting stage. During this period, the ownership will be with the companies, right? Whichever company you are working for. Once the vesting period is done, then only the ownership will come to you. Then you can sell these ESOPs and enjoy the money. Otherwise, the company will enjoy that money. W for watch list. The name itself suggests watch list. You create your own list of stocks or other securities in the stock market and keep observing how the market behaves. Is the list going up, or is the list going down, or staying same? I'll give you an example. Now there has been a buzz about artificial intelligence, right? War between US companies and lately the Chinese competition. You can create a watch list of companies that you want to track and observe this particular market. Let's take cryptocurrency as another trend because the US is buzzing after Donald Trump became the president. You can select some crypto and create a watch list and just monitor to see if there is any potential in investing in the cryptocurrency field. Most of the platforms give easy access to create watch lists. That is W for watch lists. Oh God, 2:30 in the morning, I'm so sleepy. We just have two more last. If you're not bored, let's get done with this. X for Xenocurrency. This is not an Indian term. It is used in the United States. Xeno means the word foreign or strange. In the finance world, it is the currency that is traded outside of its domestic borders. If the US dollar is used in Japan, it's called Xenocurrency. If the euro is used in the United States, it is called Xenocurrency. I mean, the same logic should apply if the dollars are used in India, it's called Xenocurrency. But I've not seen people using this term at all. I came up with this term because I could not find anything related to the stock market with the term X. Well, I thought of talking about Xerox company, which is listed in NASDAQ, US stock market. Xerox is basically into printers, scanners, projectors, office equipment, etc. I don't know what happens when we move more and more into the digital world. What will happen to this physical equipment like Xerox company, right? Will they innovate or the demand for these products remain same? I don't know. With all the technology we have currently, the company is still in the market doing well. Let's move on to the next one, which is Y for yield. Yield in simple terms means the percentage of income generated from the investment. Let's say you have 100 rupees in the bank. That will give you 6% interest rate, which is 6 rupees. This 6 rupees is the yield from your investment of 100 rupees. Same way in the stock market. For example, if the government bond gives you 7% interest rate, this is called yield. The literal meaning is actually used in agriculture. A farmer invests and puts all his efforts in growing the crops, right? How much does he earn from the crops? That's where the real yield is used. In Kannada, it is called iluvari. In Hindi, it is called fasal. And lastly, Z for Zerodha. Zerodha is a top stock market company in India founded by Kamath brothers, Nitin Kamath and Nikhil Kamath. What I like about Zerodha is their philosophy. They don't focus on the masses. All their focus is on the customer loyalty. A customer comes on board. Zerodha puts all the efforts into making the customer's life easier and better when it comes to investing. The consistent effort into this has led them to build one of the best infrastructure for retail investors. Zerodha is number one when it comes to the profits and the amount of transactions that happen. That's why they are very, very rich. Like Sheldon says in Big Bang Theory, Richie rich.
Are vastly wealthy.
What do you mean vastly wealthy?
Well, wealthy means a lot of money. Vastly means even more. I'm not sure what's tripping you up.
Well, look, I know they have money. I don't think it's that much.
No, you're wrong. They're rich.
So how much is that?
It's about halfway between Bruce Wayne and Scrooge McDuck.
That's what they've always focused on. Loyal, serious investors who invest for a longer period of time and trading in high volumes. But they have one thing to worry about, which is their opponent, Grow. Because Grow is going into the masses, playing the user number game. Grow overtook Zerodha recently in terms of active number of traders. Two things they did really well to achieve this. Number one, building products for the masses, where Zerodha is for the serious investor who stays with them for a longer period of time. The second is going all in with video content. Pick any language. They already have a popular YouTube channel making a lot of educational content, engaging with the audience. Why does Zerodha have to worry about this? Because wherever the crowd gets bigger, right, that's where the demand tends to shift. But somehow Zerodha realized this recently that they lack video content. And they have also started massive content creation. They're also sponsoring other creators from their 01 network. just so that they own the distribution and that they're not left behind. Let's see who wins. But currently Grow is leading this content game and also winning the numbers game. So that's it for the video. If you like any of the topic from this list to be discussed in depth, drop in the comments below. Also, I made this video purely with an assumption that this might help you in understanding the simple meaning of these terms. If you find value in this, bang the subscribe button. And how long can you stare at your wife? Instead of that, go do some good things like share this video with your colleagues and friends. I will see you in the next video.